Natural gas prices surged 2% amid a rig count rally and a presidential proclamation that declared November as National Critical Infrastructure Security and Resilience Month. But what are the factors that led to this increase in natural gas prices? In this section, we will explain the main drivers behind the price movements of this important commodity. The first factor is the balance between supply and demand. This is the primary influence on natural gas prices. When demand for natural gas increases and supply cannot keep up, prices tend to rise. Conversely, prices tend to fall when supply is abundant and demand is low. Demand for natural gas is influenced by various factors, such as weather conditions, economic activity, population growth, and fuel switching. Supply of natural gas is affected by production levels, storage levels, imports and exports, and infrastructure constraints. The second factor is the weather. Weather conditions can have a significant impact on natural gas demand, especially for heating and cooling purposes. For example, colder than normal winters can increase the demand for natural gas for heating homes and businesses, while hotter than normal summers can increase the demand for natural gas for powering air conditioners. Weather can also affect natural gas supply, as extreme events such as hurricanes, floods, or wildfires can disrupt production or transportation of natural gas. The third factor is the economic growth. Economic activity can influence natural gas demand by affecting industrial output, consumer spending, and electricity generation. For example, a strong economic recovery from the COVID-19 pandemic can boost the demand for natural gas in various sectors, such as manufacturing, chemicals, and power generation. On the other hand, a slowdown or recession can reduce the demand for natural gas as economic activity contracts. The fourth factor is the fuel consumption. Fuel consumption can affect natural gas demand by influencing the relative competitiveness of natural gas versus other fuels, such as coal, oil, or renewables. For example, higher oil prices can make natural gas more attractive as a fuel for transportation or petrochemicals. On the other hand, lower coal prices can make coal more competitive than natural gas for electricity generation. Similarly, the availability and cost of renewable energy sources can affect the demand for natural gas as a backup or complementary fuel. The fifth factor is the storage. Storage levels can affect natural gas prices by providing a buffer between supply and demand fluctuations. For example, high storage levels can put downward pressure on natural gas prices by increasing the available supply in the market. On the other hand, low storage levels can put upward pressure on natural gas prices by reducing the available supply in the market. Storage levels are influenced by seasonal patterns of injection and withdrawal, as well as by unexpected events that affect supply or demand. The sixth factor is the exports. Exports can affect natural gas prices by increasing or decreasing the domestic supply of natural gas. For example, higher exports of liquefied natural gas, LNG, can reduce the domestic supply of natural gas and increase its price. On the other hand, lower exports of LNG can increase the domestic supply of natural gas and decrease its price. Exports of LNG are influenced by global market conditions, such as demand and supply in other regions, transportation costs, and geopolitical factors. These are some of the main factors that affect natural gas prices in North America. However, there are also other factors that can have an impact on natural gas prices in specific markets or regions, such as regulations, taxes, environmental policies, technological innovations, and market sentiment. Therefore, it is important to monitor these factors closely and understand how they interact with each other to influence natural gas prices. The rig count rally is a term used to describe the increase in the number of rigs drilling for oil and natural gas in the United States. It reflects the optimism of the industry that expects higher demand and prices for these commodities in the future. However, the rig count rally has not been consistent across all regions and types of rigs. In particular, the natural gas rig count has fallen sharply in the past week, reaching its lowest level in nearly a year. According to Baker Hughes Co., a leading energy services firm, the natural gas rig count dropped by 16 to 141 in the week to May 12, 2023. This was the largest weekly decline since February 2016, when the gas rig count fell by 18. The main reason for this reduction was the low price of natural gas, which has plunged about 49% so far this year due to oversupply and weak demand. Some of the major natural gas producers, such as Chesapeake Energy Corp., Southwestern Energy Co. and Comstock Resources Inc., have announced plans to cut their production and spending by reducing some gas rigs, especially in the Haynesville Shale in Arkansas, Louisiana, and Texas. The impact of the rig count rally on natural gas production and supply is likely to be mixed. On one hand, fewer rigs drilling for gas means less new supply coming online, which could support prices and reduce the glut. On the other hand, fewer rigs also means less investment and innovation in the sector, which could hamper its long-term growth and competitiveness. Moreover, some analysts argue that the rig count is not a reliable indicator of natural gas output, as technological improvements have increased the efficiency and productivity of each rig. Therefore, even with fewer rigs, natural gas production could still grow or remain stable. In conclusion, the rig count rally is a sign of optimism in the oil and natural gas industry, but it has not been uniform across all segments. The natural gas rig count has fallen significantly in the past week due to low prices and weak demand. This could have both positive and negative effects on natural gas production and supply in the short and long term. In April 2023, President Biden issued a proclamation declaring May 2023 as National Clean Energy Month. This proclamation recognizes the importance of building a clean energy economy that creates jobs, reduces greenhouse gas emissions, and enhances national security. It also urges Americans to take action to support clean energy innovation and deployment across the country. One of the key sectors that is affected by this proclamation is the natural gas sector. Natural gas is a fossil fuel that is used for electricity generation, heating, cooking, and industrial processes. It is also a major source of methane emissions, a potent greenhouse gas that contributes to global warming. According to the U.S. Energy Information Administration, natural gas accounted for 36% of U.S. electricity generation and 31% of U.S. energy-related carbon dioxide emissions in 2022. The proclamation acknowledges that natural gas can play a role in the energy transition, as long as it is produced and used in a responsible and sustainable manner. It calls for reducing methane emissions from natural gas systems, increasing the use of renewable natural gas from organic waste sources, and developing technologies to capture and store carbon dioxide from natural gas power plants. It also encourages the development of hydrogen and other clean fuels that can be blended with or replace natural gas in the future. The proclamation also highlights the opportunities for the natural gas sector to participate in the clean energy transition. It states that natural gas can provide flexible and reliable backup power for intermittent renewable sources like wind and solar. It also notes that natural gas can support the growth of clean energy industries such as electric vehicles, battery storage, and green hydrogen production. It urges the natural gas sector to invest in innovation and infrastructure that can enable these synergies and create new markets for clean energy products and services. In conclusion, the presidential proclamation that declared May 2023 as National Clean Energy Month has significant implications for the natural gas sector and its role in the energy transition. It sets forth a vision of a clean energy future that leverages the benefits of natural gas while minimizing its environmental impacts. It also challenges the natural gas sector to adapt and innovate to meet the changing needs and expectations of consumers, regulators, and investors. By doing so, the natural gas sector can contribute to building a more resilient, prosperous, and sustainable America.